where we seek to look at challenges, opportunities that even comes in the midst of the challenges, and then some strategies that are there for growth. I want to welcome you for taking time of this schedules to join. And before we begin, we would want to mention that appreciate your questions dropped in the comments sections as we go along, which will also be addressed in due course. Today, our agenda is tiered into 5. That is to look at hello, please, am I audible? If I'm audible, kindly give me a thumbs up. Please, if you join with your phone, kindly enable with your loudspeaker so that you can please hear us. And if I'm audible, kindly just give us a thumbs up. All right, thank you very much. So for our agenda for the day, we basically want to look at the central bank policy rates. I mean, that's the policy environment, some historical relationships, the divergence we have in the last 3 months, some implications for the economy, financial sector, and businesses as a whole, and the best ways to navigate these challenges, and then whilst capitalizing on opportunities. Today with us is the partner for Deal Advisory, who would actively be on this call and also contribute his expertise, by the name of Evans Asari. Evans has been with the Deal Advisory team since he joined KPMG and has developed competencies in transactions advisory, both infrastructure and transaction services. So we are privileged as his colleagues to have him today to come and give us leadership on this call. So if Evans is here, I would want to introduce him to give us his opening remarks. But before he starts speaking, I would want to add that he is a chartered accountant, and then also had his master's in the University of Cambridge in the UK. So please, let's welcome Evans to give us the introductory remarks on our webinar.
Hi,
Evans,
James.
welcome.
Good afternoon. I hope you can hear me loud and clear. James, confirm if you can hear me. Okay. All right. So I see some thumbs up. So I think maybe you can hear me. So thank you very much, distinguished guest, for making time this Friday afternoon to join us on this webinar series that the Deal Advisory unit is championing. So today's topic, as James has introduced, is focusing on the central bank policy rate, okay, that recently saw a bit of a hike, about 100 basis points increase from 27% to 28%. And I think it sort of surprised some analysts and some, policy makers, the rise in the policy rate, because I think for 3 consecutive meetings of the Monetary Policy Committee, the rate has been left unchanged. And I mean, the expectation was that this rate may possibly decline, given the fact that we've seen some of the macro indicators declining and trending towards a positive direction. But we saw a rise from 27 to 28%. And I think the committee explained that the inflation outlook didn't, help in looking at the rate, and therefore they expect that some, price pressures from different areas might, influence our inflation outlook, and therefore they need to sort of look at the policy rate and then see how it can be used to mitigate that impact. We all know on the slide that you are seeing that central bank's one main tool is the policy, monetary policy tools that it has to be able to ensure there is stability in the macro, factors that we have. So, for instance, one of them is to ensure that they regulate inflation, really. So the central bank always has a bit of a target around which it uses this tool to ensure price stability across, and therefore the target usually is around 8% plus or minus, okay, too. So the range is between 6 to 10%, but it's always been a difficult target to achieve. And so it sort of deploys a number of tools to be able to mop up excess liquidity in the system and then be able to ensure that inflation is kept within the range that it wants to be, within the range of the 20 to 23%, which is still way above the target of an upper band of 10%. So even the budget has an estimate of, I think, 11.9% by the end of the year. That's end of period inflation of about 11, which is still even beyond this 10% band that the central bank has set for itself. So it deploys a number of tools, okay, repurchase agreements, open market operations, short-term instruments, long-term, deposits, even using the reserve requirements. We know what happened to the cash reserve ratio. That, I think we had a webinar on the impact of that on banks. And so it deploys these tools to be able to ensure that policy rate is really going after inflation and ensuring that the rate is kept within the range that it has always put as a target. Given the divergence that James mentioned, that we've seen short-term instruments dive so low, even below policy rate. What is the impact of that? You see below the formula, I think those mathematicians here can understand what this formula is trying to estimate. That's the Ghana reference rate. Really, it's dropped from 27 or so percent to 23 point something percent if you look at the Ghana Association of Bankers website. And it's all because of the drop in the short-term instruments, the treasury bills, which was in the 20s, it's now dropped to about 15 to 16%. And so these are all impacting the cost of capital. It's impacting investments. And so the question really is, how do businesses manage and navigate this divergence? What are the strategies that businesses need to look at? And what could possibly be some of the things that may come up? Okay, what's the outlook given where we are trending towards? Is this divergence a blip, or it is going to continue into the foreseeable future? So these are all questions that we have very distinguished panelists here to help in the discussion. And so I will entreat all of you to participate, put your questions in the chat room, and after the presentation, we can have an interaction and discuss whatever questions that you have. So James, thank you very much. I think I'll hand over to you and Eben to then continue the discussion. Thank you very much. Hello, James.
Hello.
If you're speaking, we can hear you. Yes. Okay. All right.
All right. Thank you. So thank you for the comprehensive summary. Effectively, even ended the webinar, but we are grateful for support on this as well. And with me today is my colleague Eben. I would first of all allow Eben to introduce himself, and we go. Yes.
Hello, good afternoon, everybody. I'm Ebenezer Watson with the Deal Advisory Unit of KPMG. I'm really happy to be here, and I'm sure we are going to have an insightful discussion. So, James, thank you.
Thank you, Eben. Now, we would want to look at some relationships that has been established from prior years. That's in the history of central banks, their central bank policy rates, 3-month money market rates, in this case, T-bills, and to an extent, inflation. So with these relationships we have here, we have 4 economists here. I would want to ask you, Eben, can you just let us have a view of what is happening on this, and then the various relationships and establish out?
Right. Thank you, James. So obviously you can see 4 different plots, and we are showing the central bank policy rate, the 3 month money market rate, and inflation for UK, Ghana, the USA, and South Africa, as you said. And a few things can be brought out, and they are quite insightful, okay? From the plot, one can see that there's that obvious positive relationship between the policy rate and the 3 month money market rate. In Ghana here, we often call the 3 month money market rate as the 91-day Treasury bill rate, right? And for the central bank policy rate, we call it the monetary policy rate. In some economies like the UK, it's called the bank rate. For USA, is the discount rate. For South Africa, it's called the repo rate, right? Now, you will see that positive relationship. What that means is that the policy rate and the 3 month money market rate, they move in tandem, right? So obviously, there's a reason why they move in tandem. And traditionally, the relationship is such that if there is a huge divergence, for instance, if the central bank policy rate is significantly lower than the 3 month money market rate, what it means is that as the lender of last resort, obviously, banks can borrow from the central bank at a lower rate and inject into the treasury bill rate, which will be significantly higher. And that creates an obvious arbitrage opportunities for the banks, right? In fact, alternatively, if indeed the central bank policy rate is also significantly higher than the 3 month money market rate, what happens is that as this same lender of last resort, banks then begin to shy away from borrowing from the central bank, right? Unless there are severe crisis situations. So central banks, as a matter of policy and as a matter of practice, have always aligned the 3 month money the 3 month money market rates with the policy rate. But then obviously from the principle of the sovereign ceiling, you realize that they will not be perfect. There will not be perfect relationship because government as the most credible borrower will obviously come with a lower yield or command a lower yield compared with that of banks. And the central bank policy rate anchors the rate at which central banks lends or even borrows from banks.
All right. Thank you very much. Hey, Ben. I mean, just to clear this doubt over here, you realize that between 2020 to 2022 and some parts of 2023, we saw a spike in the inflation. Now, this spike, realize that there are varying degrees of the spike among the economies. These spikes be explained by just the COVID activities, or the fundamentals of these economies would also be a contributing factor as to the rate at which these spikes manifest?
Well, thank you. Obviously, I mean, you can see two things happening here, right? And it's obvious that post-COVID, inflation across the globe was high, right? It actually increased significantly. But then it's also apparent that the extent of the impact varies, right? And in fact, it differs. So that means that although there's that global transmission of shocks, the magnitude of the impact and the severity differs across countries. And so you have country-specific dynamics playing a huge role, but then you can't also discount the impact of the global shocks, right? So there are two things happening at the same time.
All right. Thank you. The current divergence we are seeing on this policy rate environment. I mean, we see fiscal activities driving yields on the treasury rates down, whilst the monetary policy is in at the upper end of the band. From the monetary policy side, what would you say are some of the contributors? this occurrence?
Right. So Evans has already brought to our attention the fact that starting from March, in fact, even from the start of the year, you would see that the treasury yields have been declining, right? And the significant decline or the significant drop was witnessed in March, where we saw yields dropping from 26.93 to 15.74%, right? And for that matter, policy analysts and a lot of analysts, financial analysts and economists expected the central bank monetary policy rate to follow suit because of the traditional relationship we've established, right? But then when you read from the Monetary Policy Committee report, you get a sense that inflation expectations continues to be high and is driven fundamentally by two main factors. From the internal perspective or the internal dynamics, you would want to allude to the fact that from 2024 coming, we witnessed some disinflation trend, but then the momentum actually halted in the last quarter of 2024. And so inflation had kind of stacked or halted around the 20%, which is way below the target band, the medium-term target band. So there are concerns that inflations are still high. And then our inflation target overshot the IMF end of year target as well. And so we've not met the targets. Another thing is that from the 2024 elections, there are obviously election-induced fiscal spending, and the fiscal deficit rose to as high as 7.8%. So from the perspective of the central bank, there are still excess liquidity in the system. This is also compounded by the fact that the government has been rejecting a lot of the bids. So that excess liquidity in the system, right, the central bank intends to mop up that kind of liquidity so that it anchors inflation expectations. That's from the internal perspective. But externally, we are also talking about the uncertainty from these trade tensions and geopolitical risks. But we used to say US, Canada, US, Europe, and let's say US-China trade tensions. And now it's US against the world, right? And those kind of tariffs have the consequence of driving inflationary spiral. And so the central bank is wary of this, wants to anchor inflation so that we are on course in meeting the IMF targets.
All right. So I would want to believe that, as you mentioned, the statistical service indicates the fact that some of our inflation baskets is partly attributed to imports, as we have them there. I would want to believe that that has a linkage with the tariff war that is going on. That's my understanding.
Right. You are right. So there's also the part of inflation import, right? Right.
Thank you, Eben. Now, we can also look at the other side of the spectrum, which is the fiscal authorities. And I mean, we know that monetary policy is not largely only about price stability, right? Even though our central bank, that is the main goal. What of the fiscal authorities? What, explanations can we see for them being the reason to drive down their rates to about 15.7? That is for a monthly average of March.
Right. So, the divergence raises two major points in my point of view. One is that from this divergence, it's also obvious, one, there is that kind of independence of the central bank, right, in terms of delivering on its objective or achieving its objective of price stability. But then it's also obviously raised questions about coordination between these two actors, right? But then I think from the fiscal policy perspective, the key thing that we ought to know is that, one, from the DDEP, government is restricted in accessing or issuing bonds. For that matter, there's that heavy reliance on short-term treasuries or treasury bills. right? And once there's that kind of over-reliance, obviously, yields on these short-term treasuries are going to be high. And this is also compounded by the fact that we are also experiencing high inflation, and investors would want a compensation for this kind of high inflation. So, I mean, government's aim or major objective here is to drive down the cost of borrowing, right? And that will mean reducing the interest expense. That will also ease refinancing pressures and also improve some of the debt sustainability metrics in line with the IMF target, right? So obviously, the divergence between the policy objectives of these actors that is driving the divergence in the yields, basically.
So I think that's in summary of the facts here. We realize that the end goal for both the monetary policy and the fiscal policy is just to achieve a stability in our economy, based on the fact that even the central bank notified that our fiscal stability is one of the concerns that they are raising. Thank you very much, Eben. Now, we want to look at some implications that this divergence would be for our economy, and that is as a whole. But we've structured this into three, which would be one, looking at the economy itself. We would want to also touch down on institutions and then investors. And I mean, we being professional services firm, we deal with corporates and then other corporates that are also on the call, what the implications would be for you. So Eben, let's quickly look at some implications of the policy environment that we have now on the economy generally.
Okay, in general, of course, the moment these yields are dropping, it actually means that these short-term fiscal pressures would ease for us as a country, right? That's more on the positive note. But then you would also want to bring bear the fact that there's some information content embedded in this interest rate. So the monetary policy rate communicates or has an information content similar to the Treasury bill rate. And that information content mostly is the inflation. So for instance, from the Treasury bill rate, we expect that there is a compensation for inflation. Similarly, the central bank policy rate is expected to anchor inflation. So when there is that divergence in rate, it kind of brings out some mixed policy signals and which can slow down investment decisions, particularly as investors or businesses in general would want a benchmark for returns when making investment decisions, particularly in this very short term, right? But then there's also the question of weakened monetary policy transmission. Originally, in the previous slide, Evans talked about how the policy rate transmits into the lending market. And that is where you see that it is a weighted average of the T-bill rate, the interbank rate, as well as the monetary policy rate. And so if really the central banks want to affect lending, it will do so by changing, right, or altering the monetary policy rate. But this is the case, the T-bill rate has diverged from the monetary policy rate. And that's the more reason, even though the monetary policy rate has been hiked by 100 basis points, you see the GRR or the Ghana reference rate dropping. So it weakens the monetary policy transmission into markets in general, right? We can also talk about the FX pressures that can arise out of this. In fact, if investors feel that the treasury rates are no longer compensating for the required risk premiums, they may want to go into some foreign denominated assets, right? And that could put some pressure on the cedi, right? And then finally, you will also want to draw attention to the fact that government will have to refinance some of these treasuries, right? Some of its borrowings, short-term borrowings. And so if investors find a much more attractive space when the government really need them, they may not be available. So that can also raise future rollover risk. But these are the general consequences, right?
So effectively, I think the point you try to communicate is that the success of these policies stands from these two authorities, has a long way to play in this in realizing the net effect at the end of the day. Now we want to move to the financial institutions and the investing public. I mean, from where we sit, we know that banks, two of their major value drivers will be the interest that they generate in terms of interest income, and then also the cost generated in funding these particular interest-bearing assets. Let's quickly look at some impact on banks in terms of their margins, borrowing costs, and to some extent, the liquidity issues that these policies has to play on their books.
Right. So generally, we would expect that some banks, right, will miss their first quarter earnings targets, primarily because of the drop in the Treasury bill rates, right? Obviously, investment securities is a significant part of banks' asset allocation. So that's one thing. And while banks' borrowings, even interbank borrowings, continue to be high, it means that there is also that high cost of funds. That is the interest expense would continue to be high, while we would expect interest income to drop. So obviously, it would affect the net interest margins of the banks. And let's not also forget that they are also dealing with some form of restrictive reserve requirements here. And so imagine having to mobilize your deposits at or borrow at some high cost, right? So you mobilize your deposit at a high cost, give some to the central bank, which is uncompensated, right, by following the reserve requirements. And then from your investment, witnessing a drop in your returns. So obviously for the first quarter, and I mean from the start of the second quarter, until they are able to make that tactical asset allocation switches, you obviously observe some drop in the performance.
All right, thank you. Thank you very much for that. Now, for fund managers that we are trying to say they should shift allocation to bills, what are the implications for them? And also to insurers, what would we say they should be looking out for in this particular instance?
Okay, so I mean, we are still on the point of the implications, right? So for any investor, institutional investor, right, that has a very heavy allocation to GOG bills, they are going to take a hit. I mean, you can't run away from that. And that applies to all institutional investors, insurers as well. And once inflation also continues to be high, what happens is that this insurance will have to meet the claim cost, which will be high at a high cost, right? But then the earnings from their investments may not also be sufficient. So generally for financial institutions and for investors in general, we expect them to take a hit.
All right, thank
For corporates, I mean, it can be good news, right? Particularly for companies that are already logged in with the market reference rate. In this case, the Ghana reference rate, the GR. Because the GR has dropped, firms that are already logged in with a GR and a spread are good to go. I mean, there's some respite for businesses, right? But I feel that it will not automatically translate into lower borrowing costs for companies, because if banks still borrow, right, at that very high rate, it means they would want to compensate to get that necessary compensation for their loans as well. So they'll find a way of shifting the reduction in the GR into the spreads, right? So it's a GR plus a spread for every floater. And so the GR might have dropped, but then banks would try and find a way of increasing the spreads just to compensate for its higher cost of borrowing. So it's good news, particularly for banks that for corporate that are already locked in with the GR. But for new loans that are going to be changed on the market, I mean, it's a matter of negotiation, it's a matter of relationship. But then it's not really straightforward that the drop in GR will translate into lower borrowings on the market.
All right. As we go along, I would want to remind that if we have questions, kindly drop in the chat box, and then also contributions that you would have, kindly drop in the chat box. Now, we can't only look at challenges or implications of the environment and not also consider some general opportunities that we have. I know as we go along, we would want to dive deeper. But if I'm on the capital markets, if I want to look at the capital markets, if I want to look at the BOJ's side, and then even bank loans and then private credit, generally, can we talk of some opportunities that are in here for us?
Okay, I mean, from my perspective, we can look at the opportunities long-term and short-term. But for now, I mean, investors, businesses are looking at how to maneuver this situation. And generally, there are also concerns about whether the drop in the rate is even sustainable or not. But in the very short term, there are opportunities in equities that businesses or investors can explore, right? So we can look at the equity market. There are still firms that are really doing well, that businesses can optimize their asset allocation in favor of equities. And also the Ghana fixed income market is also an area that investors would want to look at or businesses would want to take advantage of. Now that these yields have dropped, what it means is that these institutional investors may have some money or some funds that they want to channel into other opportunities. And so if you're able to offer bonds that are quite attractive, let's say more attractive than the Treasury yields, what happens is that you're going to get good subscription for that. I mean, that also depends on the corporate characteristics. Let's not forget about that. But then I think that over the medium term too, we need to start thinking about some opportunities, right? And one being reviving the domestic bond market. I'm particularly passionate about the domestic bond market because it's actually a very critical market for economies across the world. In fact, for bonds, in fact, for even Ghana here, we are not only considering issues of refinancing upcoming maturities. And for that matter, we need to start looking at how we can revive the domestic bond market. But another thing is that having a vibrant bond market also supports the activities of the monetary policy. What happens is that with a very good or efficient bond market, a vibrant bond market, the monetary policy actors can be able to infer inflation expectations over the medium term. And they can also evaluate the effectiveness of some of these decisions. In fact, for some time now, you have a lot of people raising questions about whether really some of these hikes and drops have been effective, right, in curbing inflation. But a quicker way of assessing the effectiveness will be its implication on a bond market. So if you don't have a bond market, then it makes the effectiveness of some of these monetary policy decisions, let me put it, quite ineffective, right, or low, right? So you will need a bond market to support refinancing and also support the actions of the monetary policy. And also, we also want to talk about asset allocation for pensions. In fact, for the past few weeks now, there have been discussions about how to turn pension funds into other investment, into reviving the economy. But then there are several restrictions per the rules by NPR, right, in terms of asset allocation. So I think it's also time we start looking at how to reassess the asset allocation constraints on pension funds, because these days the restrictions are such that even if equities are doing so well, because of the caps, they cannot make some of these significant tactical switches to some of these instruments, right, or alternative instruments on the market. So there's set restrictions that we must begin to look at, right, and capitalize on future opportunities. I think another opportunity I want to talk about is in respect of other financial products. So you see that in Ghana here, because of liquidity conditions, even on the equity market, our market is not so liquid, right? And then the availability or access to other financial products is also limited. And so whenever you have this squeeze, you see businesses and investors in general, taking major hits. But then if there are other products on the market, but investors, businesses can make quick tactical switches, right? So we can talk about ETFs. Currently, there is one gold-backed ETF on the market. We ought to incentivize the listing of some of these products. We can talk about asset-backed securities. Okay, some of these ETFs like the gold-backed securities. Now, if investors want to have exposure to gold, I think their primary contact will be the Bank of Ghana Gold Coin. But as the major producer of gold in Africa, we ought to incentivize, right? We ought to create that channel where we have some of these gold-backed instruments on our market to give investors more room for allocation switches.
Thank you, Eben. So I think if I get a sense here, what we basically would have to do, even in the medium to longer term, is to deepen our financial markets so that, events like this can be well synchronized in, right?
Right.
Okay. Thank you very much, Eben. We would want to look at specific opportunities, in terms of strategies that various sectors can capitalize on in this particular environment. And maybe let's look first of all at the insurance and pension funds. What is there for them? What strategies they can adopt to be able to navigate this environment?
All right. So, due to the drop in the Treasury yields, investors would want to look at optimizing their returns. And so, most definitely, you know that equities being more riskier also commands higher returns. And so, subject to asset allocation restrictions, we expect that investors should move more funds into the equities. Our market is not so liquid, but there are some companies, what we would want to call the Ghanaian blue chip companies, that have favorable cash flows. They are doing well, they have healthy cash flows. We would want to optimize, subject to asset allocation restrictions, investments in these equities. Also, we now also want to look at opportunities in alternative investments, like infrastructure. We also want to look at corporate bonds on the Ghana fixed income market. These are opportunities that we expect insurance companies, pension funds, and institutional investors to capitalize.
So in the backdrop of your last submission, that would mean that we would also, for corporates, we would also expect that they should also look at more listing on the market so that this particular objective will be achieved. Now, banks, what can they do?
Okay, I guess you are referring to corporates rather. Yeah. Is that correct?
Yeah. Yeah, corporates.
Okay, for corporate entities, like I said, when it comes to banking relationships, it has to do with the strength of the relationship, right? And I think it's about time, like I also said, the drop in the GR may not necessarily translate into lower borrowing costs because there's that spread that banks would want to capitalize on. And so corporates should begin to negotiate with their bankers, right, for favorable terms. And then there's that room for chasing supplier credit as well. So for the purpose of working capital management, you want to optimize your payable days as much as possible. Okay. And then corporates also have the opportunity, like I said, to issue commercial papers and bonds. So these opportunities are there. We think that by capitalizing on them, interest costs can go down.
All right, thank you, Eben. Then finally on this, on capitalizing on opportunities, it is said that banks have a good contagion effect, and happenings in the financial sector, specifically for banks, has a long way to go, a ripple effect on the general economy. Now that we are in this rate environment, if you are running a bank, what will be your go-to actions?
I think a key thing from the Monetary Policy Committee report that was issued just a few weeks ago that people have not really paid attention to, some people have not paid attention to, let me put it that way, is the issuance of that 273-day bill. And that will obviously be anchored by the monetary policy rate. And so there's room for banks to shift that excess liquidity to these OMO bills, right? So banks can play around the Treasury bill rates and the Bank of Ghana OMO rates, right? And then I think banks should also start negotiation, if they've not, with the providers of some of these deposits, like term deposit. You know, the Treasury bill rate also anchors the movement of the term deposits. So what happens is that if banks are able to renegotiate these term deposits to align with the drop in the Treasury bill rate, it creates that room for even a potential arbitrage, right? Where straight the bank takes the term deposits and pushes them into the open market operations, like the 273-day bills. Then we also know that once yields have dropped, one way you can optimize earnings is to increase your investment. So if yields halve and you double your investment, you are able to generate the returns that you could have gotten had the yields not halved in terms of nominal value, I mean. So if banks are able to aggressively mobilize cheaper sources of funding, it means that there's money to pump into some of these interest-bearing assets, even if it's the T-bill rate, right? But then obviously, banks will be considering the impact of the CRR requirements on cost. Then we also talked about the potential for FX pressures. And so banks would want to be prepared for any impact of FX volatility. And that will mean also building foreign denominated assets. But then also you remember also from the committee reports, their eyes are wide open on banks' net open position limits. So that means that it's subject to the open position limits, but banks should begin to start building some of these FX denominated assets, right? Like FX denominated loans, particularly. And it's time to do full financial intermediation. That's what I always say, right? Banks should get back to their core duty of financial intermediation, meaning granting loans. But we are also wary of the fact that there are still risks and non-performing loans are still high. And so that will mean trying to grant more quality loans, increasing as allocation to the quality loan portfolio. And we think if banks can strengthen or deepen relationship with DFIs, right, to provide some form of partial credit guarantees, it can go a long way in helping with credit risks, right? So these are some of the opportunities and how to capitalize on them that I think banks could employ.
So before we move on, I would that is if you would agree. I mean, in terms of the BOG's OMO bills, and then taking arbitrage opportunity, that's a riskless profit, right? I mean, to what extent do you think, because we would believe that the success of banks to continually do that is also dependent on the BOGs, the width that the BOG can go. So if there's a limit to the BOGs, I mean, ability to take up these OMO bills, then we would expect that banks will still have to look for other ways aside the OMO bills. Don't you think so?
Yeah, you are right. In fact, from per my understanding, from what I know, so far, the Bank of Ghana has not turned down bids for these bills, right? Open market operation bills, like the 56 and the 273, which will be introduced later on. But you could also get a sense that Bank of Ghana is ready to take a hit on its balance sheet just to anchor inflation in the very short term. And so far as inflation really drops in line with the drop in the Treasury rate, we expect that some of these pressures will come down, right? And I mean the pressure to mop out some of this liquidity. And so Generally, it depends, right? It depends on several factors, and the ability of the central bank to do that depends on the reserves that it has, the capital that it has. And it seems to me that it has communicated that it wants to be serious about addressing inflation. And let's see, I mean, to what extent it can accommodate issuance of these bills to address that.
All right, thank you, Eben. I mean, in the midst of all that we've discussed so far, the challenges and also the opportunities, I mean, one thing we want to bring to bear is the fact that the role KPMG can play in helping clients, I mean, both on a smaller scale and then larger corporates, is the fact that we have specialized units that has the technical know-how in dealing with this. We have our audits, our tax, and if you come to the advisory wing, you see our management consulting there, where we have our strategy and operations. And I think that these units play a very crucial role in times like this. You have our people and change and transformation program. If you go to the risk consulting, where I see my financial risk management guys can play a very critical role over here too, just as your financial management and your accounting advisory services. So all we want to say here is that in the midst of all this, we have the solutions for you. And with the various business lines, anytime you touch base with us via social media, we would be able to help. But specifically deal advisory, what would you say we can do for clients in this particular climate?
For deals, our service offerings has been tailored to support businesses across the business cycle, right? That is from peak to trough, from periods of growth and in periods of recession. We have the capability to assist businesses. And so currently, one would suggest that we are on the path of recovery. And times like this, that's where businesses are concerned about their debts. Businesses want to know how they can refinance, where capital structure decisions come to bear. And so in times like this, we have the capacity to provide debt advice, due diligence, financial modeling to support the strategy, right? Be it transformational strategy. And in fact, times like this, in part of recovery too, businesses are also looking at capitalizing on some other opportunities. And we also offer commercial due diligence in the form of feasibility studies. We prepare business plans to assist businesses generally. And so if it's about refinancing, if it's about capital raise, if it's about strategy support, then the deal advisory unit has the capability to assist in that. But then even beyond the current business cycle, when there's full recovery and there is growth, that's when you talk of M&A, mergers and acquisition, and sell off or even spin-offs. And we provide M&A advice, valuation, vendor assistance, buy-side support, and all the financial advisory services that you can think of. So we are well positioned to support our clients in this landscape.
So I believe in a nutshell, what we just seek to say here is that whatever the issue is, be it audit, be it tax, all the business advisory services, we have the capacity and we have the human capital to also deliver for you. You are our valued clients. Before we would go on, I would want to know if you have any questions in our chat box. Do you have any questions or comments there? All right. So if there are no questions, hello, Ben. Do you have anything else to add to this?
Yeah. So I was saying that we can ask our participants to send in their questions, right? We are ready to take their questions and provide the needed answers.
Or also raise your hands. Then we unmute you so that you can ask your questions if you can't type at the moment. Okay, so Eben, I would want to believe that we have individuals also on this call. Personally, I would want to know if I'm an individual that has joined this call, probably my concerns or my needs have not been touched. How, as an individual, can I survive in this climate? I mean, in terms of my investments portfolio and all that, as an individual.
For individuals, well, I mean, in Ghana here, if you are talking about individual portfolios, then probably you would want to talk about high net worth individuals, right? And in that case, the instruments are there, right? Like some commingled funds, mutual funds, and some of these investments. But I want to look at the individuals from our general borrowing habits or opportunities that are there for individuals to borrow. And now that the GR has dropped, of course, there are questions about whether this drop is sustainable, whether the drop in the Treasury bills are sustainable. Sustainability comes into play because if it's not sustainable, then it means it's going to go high again, which will mean the GR coming up again. But whatever the case is, we've seen that there's a drop in the GR. So then it comes with some respite for individuals as well, especially individuals that have borrowed on a floating rate smooth. But then for new loans, I think maybe there are individuals who may be considering going for new loans as well. And the GR previously would have kind of halted that kind of decisions. The current drop means that there's that opportunity to start going to your bankers to discuss opportunities for getting access to loans. And obviously, there's that optimism on the market that we are on the path of economic recovery. And so if you are negotiating for loans, you not only look at the current environment, but then the prospect as well. That's something banks are aware of. So there's opportunity for individuals to, at least those who are interested in borrowing, right, to capitalize at this particular moment. And I also see a question that do we foresee TB rates coming down further? Well, for me, decisions surrounding the drop in the TB rate is driven from two perspectives, right? You can talk about the market, that is purely from demand and supply as well, and the other from the government initiatives, right? So the sustainability of the rate depends obviously on the trajectory that inflation follows, right? And government fiscal stance. And so it's more of a wait and see, right, from my own perspective. And so far as government continues to turn down some of these bids, it will definitely go down. But then it all depends, right? It all depends on the government fiscal stance generally. So it's not so clear cut, right? It's not so clear cut from my perspective.
All right. Evans's hand is up, so I would want to ask Evans if you would please want to take a bite at that question.
Hi, James. Yes, thank you, and thank you so much, Eben, for your very brilliant answer. I think on the individual question, I think most of the participants here are individuals who probably may be thinking of, putting money into, the Treasury bills, and then we get, calls from individuals who are, trying to put some money there. I think that the drop is not a good news, okay, for for people who think that that is a very safe and alternative investment. Okay, so I think depending on your risk appetite, people would still want to take that, instrument because it's a much more secured and what is available now because the bond market is more or less inactive for that. So individuals need to just look at the portfolio and based on your own risk appetite, if you are, that risk averse person, then you want to take the lower, rate because you believe that that is a much more secured instrument for you. Secondly, I think you mentioned also that we don't know if this will translate into a reduction in borrowing rates because there could be a lag in the policy, transmission. So usually it doesn't take effect immediately. So it takes a bit of time. So individuals need to just monitor their personal loans and what have you and see whether there's an opportunity to refinance in the event, especially when it is a fixed rate. If it is, possible for you to refinance and get a lower rate when maybe the borrowing rate drops, then you can take advantage of that and then see how you probably take advantage of the lower rate. On the question of whether T-bill will drop further, I think the behavior is quite abnormal. It's opposite to what we expect it to be, that T-bill rates will drop significantly. In fact, there is a school of thought that the whole idea is to probably get back to the bond market, okay, so that that will be revived because government realizes that the short-term instruments will not be a sustainable source of financing government policies and programs. So there is the need to move back to the long-term sources of finance, which is the bond market. So whether it will drop further, of course, supply and demand comes to play because that is the instrument that is available that money is chasing after. Then, of course, the price, government can decide that, look, I have so much money, and therefore, if you want me to take it, then take a lower rate. And so that is a possibility. But if the market decides to correct itself, then probably the rate where we are seeing now is below what it should be. It should probably be trending to where we expect it to be in tandem, with the policy rate, as Eben showed in other markets where they are all moving in perfect lockstep. So it is a difficult question to answer whether it will drop, but it all depends on supply and demand characteristics and how soon, the bond market will come to play, and therefore money moves away from the Treasury back to the long-term market. So that is the intervention I wanted to make in addition to what Eben said. Thank you, James.
Thank you, Evans. I mean, Eben touched on commingled funds, that's to say mutual funds. And I will just add that, I mean, there are mutual companies or investment firms that do those in our space here. I mean, a little research can point us to those directions. But more importantly, one question I would ask myself is, will I take lower yields on the treasuries, or I'll keep the money in my pocket as an individual investor, where inflation is eroding it and I'm not getting anything at all on it? So I believe that that's what individual investors can look at and then or consult their investment advisors. You can come to us, like we always say, and then we would take you through those complexities. Any other questions in the chat box? Please, let me get that. Okay. Ebenezer Adote Ado said there are indicators that the government is planning to enter the bond market to extend the maturity profile of public debt and improve market liquidity. My question is, from where you sit, do you foresee investors responding positively to this strategy? And how will the government balance its borrowing strategy coupled with the fiscal constraints to cap external borrowing at 250, I believe that is billion, or is million for 2025, million for 2025. Eben would want to take a bite, or Evans, if you would want to have a go, or Eben, either of you is free to take it up.
All right, I guess I can take a bite. Well, I mean, you look at our investment climate and you need to think about the options that are available, right? And so there are several constraints, even in terms of instruments available on the market. And currently that the yields has dropped to 15%, especially the next 1 day period. You ask yourself, and the government keeps on, rejecting bids. It means that there is that liquidity there, excess liquidity there. Investors would want to invest. but then governments do not want to accept these bids at that higher rate. And I think from that perspective, you ought to think that there's that opportunity to gradually ease into the bond market. So, I mean, if the government intends to enter into that bond market, it has to be gradual, right? By issuing, for instance, 2-year bonds or 2-year notes. So start from medium-term notes and then gradually ease into the longer term, right? So it's possible. And like I said, there are several constraints on the opportunities available, which means that entering into the bond market can still be attractive to several investors currently.
All right, thank you, Ben. I don't know if you would permit me to take the next question. I mean, take a bite at the next question. It says, with the city facing periodic depreciation pressures, how can individuals balance local investment opportunities with the need to preserve value, especially in foreign currency terms? And the second one, apart from T-bills, any other investments one can invest in. I think along the way, Eben indicated a gold ETF. And we know that gold is actually a good store of value. So, I mean, if there are opportunities like that on the market, why not take advantage of them? But that's just my opinion. I don't know if Eben or Evans would want to add anything to that.
Well, like as we said, there are opportunities on the market, right? But you always have to consult a financial advisor. And we talked about the opportunities in equities, right? In the bond market, etc. But in this case, you ought to do rigorous financial analysis and match returns with your risk appetite. And that's where a financial advisor comes in. So what we can do is to tell you where the opportunities are, but rather we can't really tell you to invest in them because it may not even match your risk appetite generally.
And I think one more question in the chat box. It says, also in this
James.
environment of... Hi, Evans. I can see
Yes.
you are muted.
So just a quick comment on that. So I think there's a fundamental issue around inflationary pressures. Okay, first we have the local inflation, and then of course the currency depreciation. So the question really is around how do we preserve value, okay, of our investment vis-a-vis the depreciating currency, and then this, inflation as well. So I think, unfortunately, the instrument, if you have a local currency, which is the local assets that you have to invest, I think I had a statement by one of the professors of finance that it is unpatriotic to buy foreign currency as investment. So it was quite a very controversial statement that when you buy foreign currency and then you are not being patriotic because you are putting pressure on the CD and then you are going to force it. And then someone queried that up, but there's nowhere in finance that we talk about patriotism. Finance is about return and risk. So why would you talk about patriotism when we are talking about investment? Okay, so I think it is important that individuals, as we build our portfolio, we have the financial markets, we have the money market, we have other asset classes that you want to invest in. Okay, so for those that require special analysis, so investment advisors can help you to be able to determine how you allocate your assets to some of these, different instruments. But I mean, as an individual, I think there are other opportunities that you can use to preserve value. Aside, maybe if you want to buy foreign currency and keep, that's fine. But real estate investment is one option. And I know there are couple of plans to bring the real estate investment trust where you can invest in real estate, not by building a house, but you can buy some instruments that is backed by real estate, just like the gold bank backed ETFs. But this one is backed by real estate, so you can invest in those assets and then build your own investment portfolio. At least real estate, they say, is a hedge against inflation, so it can help to preserve that value as an individual. So that is the addition to the one Eben mentioned. Okay, thank you so much, James.
All right, Evans. Thank you very much. And one more. I like that. Spot on. No patriotism in finance. Obviously, will I want to be patriotic and erode my wealth? But that's another discussion for another day. Nana K. Bediako, also in this environment of monetary policy tightening, what financial habits or adjustments will you recommend for individuals seeking to build resilience against inflation and potential economic shocks? Eben or Evans, any of you can take a bite.
Okay. I mean,
Okay, so let me probably.
Yeah.
So I think
Evans, please go ahead first.
in
then I will follow.
the environment of monetary policy tightening, what financial habits or adjustment would you recommend for individuals seeking to build resilience against inflation and potential economic shocks? I think as an individual, I think it's more about looking at your inflows and outflows. There's very little you can do on controlling what happens on the economic environment. You can't do anything about it. Okay. Yours is to see what you can control within your financial environment. And so it's either you are cutting down expenditure or you are increasing your source of income to be able to balance the budget. That is number one. Okay. So if the budget line is such that it is so tight, then consider doing austerity, just like any economy will do. Okay, when it is facing financial challenges, it goes through certain austerity. So you just have to also consider as an individual which part of my expenditures are discretionary that I can forego. So Ghana had to do that. We look at discretionary expenditures that you don't necessarily need. So that is one you want to consider. Number two, how do I increase my top line, my revenue? Okay, so are there skills and behaviors in the period of AI and all that? What can I develop to be able to add value to myself, and therefore I can increase my inflows? Because you can either increase your inflows or cut down your expenditure. Okay, and then those are the things that are available to you. And I think the third one will be to really get knowledge on the financial and investment landscape. Okay, and be wary of investments that are offering quite good returns, because when it is too good, then it may not be too good to be true. So just be wary of that, and then consult advisors to be able to help you make wise investments, because really it is very difficult to earn money, invest it, and just lose it because you put it in the wrong instrument. So I think these are my tips for individuals in this difficult monetary environment. Thank you.
Eben, will you want to add to that?
I think it's been sufficiently addressed, right? If it's about hedging against inflation from the investment point of view, that's when you look at some of these investments that we talked about, alternatives that we talked about, exposure to gold, possibly, and to real estate, right? But from a pure financial habits point of view, you want to monitor your expenses and also want to see how you can optimize your income generally based on the principles that Evans has brought to bear.
So for Nana, the most recent question is, what lessons can individuals draw from previous monetary cycles in Ghana to avoid common pitfalls and make more informed decisions in today's environment? I think that, Eben and Evans especially have stressed the need for you to look at your expenses well. Until recently, floaters may be seen to have been stable, but we realized that in 2022, when the economic stress started hitting Ghana hard, and then rates started increasing, you realize that whoever had facilities in terms of loans, the cost of that particular facility would have increased exponentially. So for an individual, from previous monetary cycles, I believe you should also, in the period that, the economy is relatively stable, you should monitor how you take on debt, and then also how you make purchases, just so you can stay afloat when the economy takes a downturn. We have Kumaga Delaliao. He said, how can we invest in real estate when houses are so expensive? Was Evans, I think you addressed this. I would want you to come and throw light on it again.
Delali, thank you. It depends on where you are buying your house. Anyways, if you are buying your house in cantonments, then then you'll be paying in millions of dollars. But if you are buying your house, in a moderate location, I think it is something you can always plan for it. So, Delali, that's my premise to your question. But substantially, I think you make a very important point that given the prices at which real estate in general, is going up, and even the fact that our currency is such that, I mean, even if a house is priced at $20,000 today, it means it's like almost 300 and something thousand Ghana cedis. The question is, how do I make an investment in this? Mortgages usually would have provided another route for investing in real estate, but we have come to realize that, especially for the dollar-denominated mortgages, the cedi depreciation really impacts them, and therefore sometimes you can pay over a very long period and you will never finish paying down your principal. So you want to look at cedi-denominated mortgages, and I mean that's one thing. And remember that even your pension fund, the tier 2 and tier 3, there are options for you to use part of that as deposit for real estate if it has reached that, I think that is it 10 years, you can use part of that as deposit for real estate. And therefore, you can consider that and then look at your pension and see whether it is enough for you to pay down deposit for real estate, and then you can pay the rest over a period. So there are various ways you cannot wait and have $1 million Ghana cedis to pay for a house, but look at the various options available and then see how you can sustainably and reasonably pay over time to be able to invest in real estate. I mean, real estate, we all know, even it can just be land, service land that you bought and leave it there as an investment property. Over time, you can sell part of it and recoup your equity to be able to build on another, land. So there are various ways you can do this real estate investment. I hope, Delali, it sort of addresses your your concern. Thanks, James.
All right. It says, Gerald, he said, hi, what are your thoughts on the impact of increasing MPR and dropping TLB rates on the FX rate? Also, what's the impact for individuals and businesses trading using FX? I would let Eben take this, and I will also share an opinion if it doesn't address.
Okay, sure. I mean, we talked about the implications on FX movements, and that's coming from the fact that there are some investors, by virtue of chasing extra income or returns, move to foreign denominated assets, right? But then
Okay. Whilst Eben joins, and I think he also mentioned early on in the presentation that the transmission of these policy initiatives has a long way to go in achieving, in investors believing in the economy. So if these policy initiatives are not transmitted well into the economy, we know that these rates are actually forward-looking, right? So it is inherently expected that if government is offering you, say, 15%, then we would expect that inflation should have dropped below that so that your yields will be able to compensate for the risk of inflation. So if this particular goal is not achieved, then investors would have to, obviously look for ways to be able to compensate for the risk that maybe government bills cannot compensate for. And for businesses as well. Okay, Ben is back on, so let me just give it back to you.
James, you are on track. So the point I was trying to make before was that investment decisions, there are some short-term and long-term investors. And for those who invest in long-term, they look at the long-term macro fundamentals, right? And the long-term expectation of the movement in these fundamentals. So it's not outright that because Treasury yields has dropped, then investors will just pull away funds. It's not straight cuts like that. And that's why I said their optimism about the economy in general, and even the medium to long term. And so investors may not necessarily pull out funds, right? Because they consider the long-term fundamentals as well. And again, when you look at the information content of the Treasury yields, most often we just benchmark the yields against the previous or the current inflation. And that's from an analysis point of view, it's not entirely correct, right? Because the inflation price in these yields is an expected inflation over the investment horizon. So if it's a 1 year, let's say, yield, annualized yield over the investment horizon, what is the average expected inflation? And so if inflation is expected to follow suit, right? If yes, inflation declines on the path that it is, and this 11.9% target we think is achievable, right? Then it means that investors would have a point to believe that inflation over the next 1 year term will be lower. And for that matter, the current yields may be compensatory. I mean, so it's not so straightforward that because of it, investors will just pull out their funds. But obviously, for very short-term investors who would want to hedge against potential FX pressures, that's when they want to convert their investments into foreign denominated assets. And even for the United States dollars, there is that pressure on the USD currently because of the tariffs. So you ought to be very cautious. And as Ivan said, you will need to monitor the investment landscape and climate before trying to make any decisions around that. And if there's anything to go by, the cedi has been stable for a couple of months now because of the forest reserves and because of the fact that the central bank has been active in trying to provide liquidity, FX liquidity on the market. So there is that commitment to maintain some form of stability of the exchange rate. So I'm sure there's no cause for panic when it comes to this, right?
And we have, please, in Ghana, do we have any ETF that tracks the GSE? From where we sit, we know that there is no index. There is no index that has the whole market. Okay, there's no index there that has the whole market that maybe investors can take passive exposures to. But in Abraham's presentations earlier or submissions earlier, he mentioned that there is a gold ETF. And we know that the gold ETF does not track the GSE as a whole. So that is what we would want to mention. He said, Abuchi, Eben and James, I'm very interested in how within a very short term, January to March, we are already having excess liquidity in the economy. Any hints on how this came about? Amen.
Well, so if you've monitored the subscriptions for the TB rate, you will obviously see that the government has turned down more than 20 billion Ghana cedis, right? So where is this money going into? Just think about it, right? And so the liquidity is there that the monetary policy actors will want to move out.
I don't know if that addresses your point, Abuchi. Because even if you followed the most recent auctions, the last one that was done last Friday, government's target was not met, but government still rejected some bids. So that is what he's saying. Where is that money going to? It is, would the banks just allow it to sit on their books? So that is liquidity that will be in the system that the monetary policies would have to mop up. All right, I think we are almost through with our time. If we don't have any other concerns, I would want to defer to Evans for any concluding remarks that you would want to share.
Sure. Thank you so much. Okay, so Abochi has just dropped another question. So where was all this liquidity for the past year? Abochi, we wish we had that eye to be able to track the liquidity where it was sitting. Okay, but I think whatever the case is, remember we've just come out of elections. Okay, 2024 elections. So there could be a spillover of some of the expenses. Okay, that occurred last year. and therefore there's quite a bit of money in circulation. So the liquidity for the first quarter of this year might not have just happened within that year. It might have been some excesses that are coming through here. And then obviously the instruments are limited. The bond market, okay, nobody wants to go in there. So really there's cash sitting there, and then they're asking themselves, where do they deploy this cash? The Ghana fixed income market appears to be one area that is also becoming a bit more vibrant, but we need it to be to be a bit more active, so that pension funds and then other investments assets can be deployed to those funds. I think more importantly, the panelists have given us a lot of insight into what is happening in terms of the relationship between the policy rate and treasury rate. I mean, for some reasons in other countries, in India, the Reserve Bank rather cuts policy rate. In Canada, the Bank of Canada cuts policy rate. And then I think the same for European Central Bank. But I think the economies there are differently modeled, so that they see a lot of impact on this trade war between them and the US, and therefore the impact on the local economy is dear to them. Therefore, they want to ease the monetary policy so that expenditure and then consumption in locally would happen to drive the economy. But in our case, it's different. Okay, we are just in an IMF program. We have limitation even on borrowing, $250 million. And therefore, government at this stage has a very difficult task to just service the debt that it's restructured. There are headwinds ahead, okay, because we are going to pay a lot of debt in the next 2 years. The minister said about 150 billion Ghana cedis over the next 3 years, from 26 to 28 or so. We need to pay domestic bondholders, and external bondholders too. We need to pay about $2.something billion. These are all coming to hit us. Where are we going to get money to be able to pay this debt? So let us brace ourselves. I think it's going to be an interesting ride, okay, and we'll see how government is able to sustain that. At least from the fiscal point of view, we know government has tightened expenditure, so it is being a bit more cautious in where it deploys the money it is raising, and therefore it has committed to paying the debt, and it cannot default because it wants to go back to the bond market and to be able to raise long-term bond for projects and programs. So it has only one option: to be able to honor those debts that were restructured. And then lastly, what I'll say is that for individuals, we've learned quite a bit here on how we look at our portfolio of investments and how we reallocate them. If you have debts already, just make sure you don't take more debts on yourself, because it's going to put pressure on you. See how you can refinance and reduce your interest expenditure. And then I think ultimately, once the economy is performing well, once inflation is coming down, once exchange rate is stable, and then once we have economic growth, I think it will have a feel through, an impact on our pockets. We'll feel it in our pockets. Our disposable incomes will be as we expect it to be. And then we can also deploy our assets to the investments that are required. So thank you all for your participation this afternoon, and a big thank you to our speakers as well. James, over to you to close. Thank you.
All right, thank you very much, Evans. Even any final word? So maybe your goodbyes, let me say. Let me put it that way. Because
all right, so thanks for having me too. Enjoy the rest of your day.
All right, before we drop off, I would want to say that we are accessible through all our social media channels. And if you have our email addresses, we are always approachable. Kindly endeavor to reach out to us for anything advisory as it relates to your finances and then your investment decisions. We are glad to help you as always. Thank you very much for making time out of your schedule to join us. Thank you. And have a great day. Still sharing.